Let's get across the market open. What we're seeing more broadly at the moment, Kerry Craig joining us from JP Morgan. Kerry, welcome back. Good to see you again here at AusBiz. Let's begin stateside. Just in that session gone, stocks taking a bit of a tumble, those bond yields rising, certainly on concerns about the US deficit position, particularly in light of Donald Trump trying to push through his tax cut bill.
Yeah, good morning, Andrew. There's a couple of things going on there in the US at the moment. I think the first is that you've had a lot of the news around the sort of stepping back in tariffs, the move towards those pauses when it comes to the US, the rest of the world, and the US against China. That kind of momentum has moved through the market already. Valuations have gone back up. And so I think that on the equity side, investors are now looking at, where the earnings outlook is going and trying to digest what some of the moves may be from here. So that's taking a little bit of heat out of the equity market. And then adding to that, obviously, is what we've seen around the fiscal space. Bond yields at the longer end of the curve have moved up, quite sharply in the 30-year space. Seen it trickle into the 10-year as well. And it's all coming back to not necessarily the downgrade that we saw of the credit rating for the US, because that was not new news, something that had been in train for a while, but the ramifications around what this fiscal bill could look like in terms of adding to that deficit and debt pile, and again, raising these questions about demand for US treasuries when there is these fiscal concerns leading to those yields going back up. And then the knock-on effect into equities is around the valuation. So things that are deemed to be long duration, they would have a sort of a negative reaction when those yields go up. So I think there's still a lot more to come here in terms of fiscal support for the economy, but we're likely to hear a lot more from, I think, the fiscal hawks in the Congress around, the cut by the rating agency, as well as just some of the details within that fiscal bill and what it'll actually look like. But by and large, I think that fiscal risk is really one for the longer term and not one for the immediate term. I think the ramifications are more around how much front loading there will be in that fiscal stimulus and what that really does to the inflation outlook in the US economy.
So, Kerry, if that bill gets through in its present form, what's the likely reaction then, particularly in terms of those treasury yields?
I think if you look at the details in that bill and the timing that's set out for it, obviously, when they come to pass these budgets, they're looking at the 10-year time frame. They tend to front load a lot of the spending and then have a lot of the tax cuts come in the later years. That way they can say over the 10-year period, it's not having the biggest impact. And so I think when it comes to that, you'll be looking for just how much of that stimulus will be expected to come through in this year and next year. And again, in an economy where you have a very low unemployment rate already, where there's not really a huge amount of spare capacity, what that does to the inflationary outlook. So our assessment would be that you might see the market start to contend with not only the inflation aspects of tariffs and what they mean, but also of this extra demand that could be put into the economy, and raising those expectations for where inflation may go. You've already seen it with the pricing out of rate cuts in terms of the Federal Reserve. You might see those expectations for what it does to the inflation numbers feed into looking at a little bit higher yields at the longer end of the curve. So a bit more perhaps of curve steepening coming through. But I think balancing that out is the idea that, there is still these risks to growth in the US economy. There still could be some downside risks if the tariff negotiations fail. And therefore, we should think about the duration at the shorter end of the curve relative to the longer end of the curve in the portfolio.
Yeah, given what we've seen with equity markets, Kerry, do you feel as though perhaps investors being overly optimistic, perhaps pricing out that, well, as you would term their worst case scenario, particularly in light of that agreement between the US and China, even though nothing's actually been set out?
Yeah, it's similar to what we saw with the US and UK, where they kind of came out and said, we've done this deal. What the UK thought was done was a little bit different to what the US was done when those initial releases came out. And I think it's more of a framework that was engaged rather than an actual deal. And that could potentially be what we see with China, where it's more of a framework for agreement around tariffs and buying of goods, and not necessarily 100% a solid deal, even if that's presented as one. And that could mean that it's come to sooner. You get a sooner conclusion on that because you don't have to go through fully negotiating a deal. And doing that takes an exceptionally long period of time. So outside that 90-day reprieve that we have. And so those are the risks. But I do think that the movement away from the market thinking about that worst case scenario, these 100% plus tariffs that were put in between China and the US having gone away, thinking more back to maybe something that was similar to the status quo, even if we do have higher tariffs overall, but yet not really thinking about the best case scenario, and that's the risk that the market starts to thinking that this is all behind us when we still haven't seen, a full gambit of earnings downgrades come through. We're still hearing guidance from some companies about the risks of higher prices coming through in the US and what that could mean. And so we are thinking about the market that could be facing this and these fiscal shocks that leads to another down period of the market. And I think that would be perhaps more a buying opportunity if it did present itself, given that we do have no longer a recessionary view being built in, given this climb down on some of the tariff narrative.
So given those risks, the ongoing uncertainty, are you taking a more defensive bias at this point?
To a degree, I think there's been some cyclical opportunities in the US market, particularly, that have become more attractive given the sell-off we have seen. Those may have evaporated a little bit quickly given the rebound in the market, but they could present themselves again. Some of that fiscal stimulus will be beneficial to some companies within the US, domestically focused ones. So I think it's important to be very active looking across the US landscape and the equity market for cyclical opportunities as well as defensive ones. And if we do get further movement in terms of regulatory changes, that could help the banking and financial sector as well. That's not typically defensive, but it's typically high quality. So I think there's opportunities across the US landscape. Our point of view around the US is that we're still neutral overall when it comes to an allocation towards US equities. It's more around that narrative of thinking about the sell America that's been permeating in the market with the drawdown in the bond space, the fixed income, the currency as well. And then the equities, where we're taking the view it's more about rebalancing America, where it's been a very strong performer for a number of years in portfolios, may have got a bit outsized in terms of allocations, and just thinking about rebalancing that weight and size compared to the opportunities, elsewhere in the world, whether it's China or Europe or Japan. And so having a little bit more balance and diversification within that portfolio at this point in time.
Kerry, how are you seeing the Australian market at the moment, particularly the prospect of earnings growth here in light of where the economy is at, what we've heard from the RBA with the prospect of further rate cuts to come?
Yeah, I think there's a fairly dovish message from the RBA this week, if not, a little bit confusing at the press conference with some of the confidence around that size of that rate cut and what they actually put forward. But it hasn't really changed our view of still thinking about a further easing in policy this year, most likely to come in line with their statement of monetary policy. So further cuts coming through in August and November. And a little bit pushback on the market that's pricing in a little bit more than those number of rate cuts for the rest of this year. But I think that easing coming through is definitely a sign that we've got inflation pretty much back towards the target. It's not right in the middle of the band, but pretty close to it. Growth is obviously a little bit softer than expected. It is having the impact of some of these global slowdown affecting the economy. And then comparing that to the market, I mean, it is a case of thinking around relatively high valuations. Yes, in certain pockets of the Australian equity market, but again, more broadly, and the earnings numbers that aren't looking that great. So I think there's been a bit of resilience in the Australian economy compared to what we've seen in the rest of the world, especially when there was that strong view around the impact of tariffs and the fact that Australia was not having a massive direct impact from it. But more broadly, we are still thinking about a slower global economy, even if it's not a recessionary one. And I think that's probably going to weigh on the outlook for Australian assets to a degree. The fixed income space is more interesting than the equity space right now, and would be looking for international diversification within equities.